Welcome to Chapter 13, Risky Assets. I'd like to remind you first a couple definitions from statistics. So let x and y be stochastic variables with the following distributions. So the little squiggly sign means distributed. So what we're going to say is that x is distributed with a mean mu of x and a variance sigma squared x, and y will be distributed with a mean mu of y and a variance of sigma squared y. Then we can say for any scalars, so that means a non-stochastic number, 50, 5, 0.5. So for any scalars a and b, the statistical distribution of a times x will have a mean of a times the previous mean and a variance of a squared times the previous variance, right? So ax has a mean of a times mu x and a variance of a squared times sigma squared x. By has the distribution with mean b times mu y and a variance of b squared times the previous variance sigma squared y. And as a further result, this is a little more formal explanation of this result that I kind of threw out at you in the previous chapter, chapter 12. Ax plus by is distributed with the mean a mu x plus b mu y, and that's its mean, and its variance is a squared times the variance of x plus b squared times the variance of y plus 2ab times the covariance of x and y. Okay. Now, the relationship between the standard deviation and the variance is quite simple. The standard deviation is the positive square root of the variance, right? A variance has to be a strictly positive number, and the standard deviation is its positive square root. The way to think about it, perhaps from an intuitive standpoint, is if we had a normally distributed random variable, roughly 2/3 of all realizations or observations of a normally distributed random variable will be within one standard deviation of the mean. So in this case, the illustration that I have on the left, if you suppose that the mean were 0, what I've illustrated by the vertical lines is one standard deviation above mean, one standard deviation below mean. So that area there represents 2/3 of the probability density, right? So those are 2/3 of all realized values. So the standard deviation is often used as a measurement of dispersion, how dispersed are realizations of this random variable. Now, coming back full circle to the application of this, Varian tells us that within finance, a asset that gives a positive rate of return but is considered as close to risk-free as possible would be a U.S. Treasury bill. So the Treasury bill is the financial instrument that the U.S. government uses to finance its debt. And the way a Treasury bill works is that it is a $50,000 Treasury bill is a promise that the U.S. Treasury will pay the holder of this Treasury bill $50,000 90 days into the future. Right? So that is considered it's considered extremely unlikely that the U.S. government is going to default within the next 90 days. At least historically, that's been the assumption. So the Treasury bill is considered a risk-free asset. And suppose that the rate of return on a Treasury bill would be R sub F. So R is a rate of return, F denotes the risk-free asset. So the rate of return then is R sub f with perfect certainty, meaning it's risk-free. And if it's perfectly certain, that means that the rate of return on a treasury bill has no statistical distribution. It's RF with certainty. If that is so, that means that the standard deviation of the return on a treasury bill is 0, right? So sigma sub f is 0, noting that you will get this rate of return guaranteed. The risky asset is considered the stock market in aggregate. And suppose that the average expected rate of return for the stock market is some value R sub m. So I remember, I'm going to make reference to this book later in the lecture, but back in the 80s and 90s, the classic do-it-yourself investor book was called A Random Walk Down Wall Street, and it was written by this finance professor whose name was Burton Malkiel. And so Burton Malkiel would say that the average 30-year rate of return for the stock market, broadly speaking, was about 13%. So over a 30-year period, the average rate of return for holding funds in a broadly diversified portfolio was about 13%. It is a risky asset, so that means that there's uncertainty. There are some years in which the rate of return is above 13%. There are other years in which it is less than 13%. So there is a statistical distribution, there is risk. The standard deviation, which we're going to denote with sigma sub m, is a measurement of how dispersed actual rates of return are from the long-term mean. And it's a measurement of market risk. Now, if we consider the problem of trading risk and return, so we have return on the vertical axis, and we have the standard deviation of return or risk on the horizontal axis. We have, well, first of all, consider the one to the far right. That would be M, the broadly diversified market. So the broadly diversified market, as we defined from the previous slide, has an expected rate of return of R sub m and a standard deviation of sigma sub m. The risk-free asset has a rate of return of R sub f. That's over on the vertical axis. It has a standard deviation of 0 and a guaranteed rate of return of R sub f. So the slope of this line, which is how we could trade risk for return by buying linear combinations of the risk-free asset and the risky asset, should be the rise over run. So the rise is R sub m minus R sub f. That's the movement along the vertical axis. The run is going from 0 to sigma sub m. So the slope of the budget line, P is the price of risk. It's equal to R sub m minus R sub f over sigma sub m. Then consider some security X, which is a weighted average of the risk-free asset and the risky asset. So if X represents the proportion of the asset that we're getting, where of course X has to be positive, the expected rate of return, R sub X, is this weighted average of the risky and the risk-free return, and then we apply the variance rule that I described at the very beginning of this lecture to determine the variance of the rate of return of this composite asset. It's going to be x squared times sigma squared m, And then if I wanted to have the standard deviation, which is the standard measurement of risk, it would be the square root of the variance. So the standard deviation is going to be x times sigma m. And that's illustrated on this graph to the left. Now, if we think about the choice that consumers make between risk and return, we should draw in indifference curves. And to the consumer, to a risk-averse consumer, perhaps I should say, risk is a bad and return is a good. So what that would mean is that we have indifference curves that are upward sloping. And as before, if we want to find the optimal choice, or in this case, the optimal portfolio, what we would do is we would set the slope of the indifference curve equal to the slope of the budget line, and then choose the place where they're tangent, right? So we have the slope of the indifference curve, that's on the left. We have the slope of the budget line, which is on the right. And when I set those equal, this defines R sub x, right? That's the point of tangency. Now, if we think about how it is that we measure the risk of an individual stock, the risk of an individual stock, and let's call it stock I, is the uncertainty of its return relative to the market rate of return. So, and this is typically measured in finance by beta. So beta sub I, which would be a measurement of the risk of security I relative to the market. You notice the denominator here, sigma sub m, is the measurement of risk for the market as a whole. Upstairs in the numerator, sigma sub I is a measurement of the risk of stock I. It's a measurement of how dispersed the rate of return is. So this ratio, sigma sub I over sigma sub m, represents how uncertain an individual stock's return is relative to the market as a whole. So since the dispersion of the rates of return on an individual stock must be greater than the variability of the market rate of return, this implies that beta sub I is strictly greater than 1. You'll notice, though, if we're thinking about what beta must be for the risk-free asset, for the risk-free asset, the measurement of the variability of its return, sigma sub f, is 0. Remember, because the risk-free rate of return, the U.S. Treasury bill, you get the rate of return that you signed up for with certainty. That implies that the standard deviation of the return, sigma sub f, is 0. So that means that beta for the risk-free asset must also be 0, meaning that the risk of holding Treasury bills relative to the risk of the market as a whole is 0. Now, Varian defines risk adjustment as, in essence, the premium that's necessary for bearing additional risk beyond that of the risk-free asset. And the way that you would compute this compensation, or of course, I guess I have to remind you yet again, the golden rule of finance, which I talked about earlier, is that return is the reward for bearing risk. So if I own security I, and security I has risk sigma sub I, and P represents the price of risk that we developed 3 or 4 slides back, the risk adjustment, the excess compensation that I have to be paid for bearing that risk would quite naturally be how much risk do I bear multiplied by the price of risk. So if I think about how to re-express that, sigma sub I, which is the riskiness of security I, could be expressed as beta sub I times sigma sub m. So remember, beta sub I gave me the proportion of how risky is security I relative to the market, and then I multiply that by how risky is it to put my money in the market. So beta sub I times sigma sub m by construction was equal to sigma sub I. So I haven't done anything funny yet. And then just to remind you what the price of risk was, the price of risk was R sub m minus R sub f. That's the excess return in the market versus the risk-free asset divided by the risk associated with the market, sigma sub m. And then you see, of course, that sigma sub m cancels out, and I'm left with beta sub I, which is the riskiness of security I relative to the market, multiplied in parentheses by the excess return I get from holding my money in the marketplace relative to treasury bills. So if, for instance, I held a stock, an individual stock, that was 3 times as risky as the market as a whole, what that says is you should take the market premium, right? So how much more money do I get from putting my money in the broadly diversified stock market versus treasury bills? I multiply that by 3, since security I is 3 times as risky as holding a broadly diversified portfolio, and that gives me the risk adjustment. That's the excess return that consumers demand as compensation for bearing the risk. Again, in accordance with the golden rule of finance. Now, for any two securities I and J with expected rates of return R sub I and R sub J in equilibrium, this expression that I developed from the previous slide must be equal across different securities, right? So we have the rate of return minus the risk adjustment has to be the same across securities. So we could do a variance suppose not proof, but I think you know how that would go. Now, what if asset J, the asset on the right-hand side of the equality, is the risk-free asset? So if asset J is the risk-free asset, that means the rate of return is R sub F. And you remember we showed a couple slides back that beta for the risk-free asset is 0. So what that means then is the right-hand side reduces to R sub F if the alternate asset were the risk-free asset. So if I rearrange this final result, I get this expression that's known as the capital asset pricing model, or CAPM. This, and if I wanted to talk through CAPM, what this is telling me is that the rate of return from holding security I is equal to the rate of return from holding treasury bills, the risk-free asset, plus the risk adjustment. You remember the risk adjustment was the excess return from putting your money in the stock market relative to the treasury bill times the measurement of how risky stock I is relative to the market as a whole. So that's CAPM. Now, if we think about arbitrage in CAPM, so I have the diagram on the left, which shows the expected rate of return on the vertical axis, and on the horizontal axis, beta, which you remember was a measurement of risk relative to market risk. So I have the dot indicated by construction. where beta is 1, that means I'm holding a broad index that perfectly represents the market as a whole. My expected rate of return is the market rate of return, R sub m. And then I have is my vertical intercept, R sub f, which was the risk-free rate of return. So what I can say then is, well, of course, I could get from this the slope of this particular budget line, and that's what Hal called the market curve. Okay. Now, the rate of return for any individual security is going to be, it's the expectation of how much appreciation I will have from holding this stock for one time period. So let P0 be the price of security I today, and let P sub 1 be the price of this security one period into the future. So P1 minus P sub 0 is how much did the price of this stock change during one time period. I divide it by my base value of P sub 0. That gives me the rate of return. And of course, since I'm talking about the future, I'm taking expected values. So R sub I is the expected rate of appreciation. Okay. Now, so this line represents, in essence, the efficient market, right? The market in equilibrium. And if we plotted stocks or mutual funds or indexes on this graph, we would have a scatter cloud of points around this line. And what Hal tells us quite reasonably is that if you had securities that were above this line, think of what that would mean. So look at the dashed line where we have 1, and imagine a fund that earned a higher rate of return than the market as a whole while bearing the same amount of risk. That would be seen as a really good deal by investors, and the investors would buy it up in expectations of future appreciation. So remember, P1 is the expected value of what we think will happen in the future. P sub 0 is the value of the stock today, or the mutual fund, or whatever it is. So if investors buy up this stock that is expected to earn an abnormal rate of return, as P increases, that drives the rate of return R sub I downward. And that process will continue until R sub I falls back to Earth, where Earth is basically this budget line. Okay. Now, I referred earlier to A Random Walk Down Wall Street, and it's a very interesting book. I think it's still in print. It surely must be. The thesis of the book was, because you might wonder where on earth this crazy name came from, the price of an individual stock, if markets are efficient, follows a statistical process known as a random walk. So the author of A Random Walk Down Wall Street, Burton Malkiel, chose the name because he's proposing that stock prices are in essence a random walk, which means they're largely unpredictable, right? Because as information is revealed, that causes stock prices to move up or down. And looking into the future, we don't know in certainty whether tomorrow will bring good news or bad news for an individual stock. Therefore, the price on any day can fluctuate in an unpredictable manner. So the central question in Malkiel's book, A Random Walk Down Wall Street, is this. I have in this first line here. Are individual investors better off buying an index fund, a broad index fund that by construction earns R sub m? So if you got a very broad index fund that means you're paying a money manager to buy a little bit of everything. There's no discretion, buy a little bit of everything. You're shooting for the average. So the question is, do you buy an index fund that explicitly does not actively manage your money, but rather tries to earn the average or market rate of return? Or do you pay fancy pants, high-priced money managers to actively manage your money and try to beat the market rate of return? Well, I showed you on the previous slide why it might be difficult for a fund to consistently beat the market rate of return. Malkiel, in A Random Walk Down Wall Street, advocates buying index funds. Just buy index funds and leave them alone, because he's saying that in expectation, with the lowest possible management fees, you will earn more in the long run than paying someone to attempt to beat the market, which, if stock prices really are a random walk, it's not possible to do that on a consistent basis. As actually a perverse counterexample, do you remember from a couple years back, it's probably been about 10 years ago now, there was this guy, Bernie Madoff, or Bernard Madoff, who was this very famous money manager in New York. He managed money for celebrities and famous people. He was in the news. And it turned out what he was doing is he was running a Ponzi scheme. So he took the money from new investors to pay high rates of return to existing investors and to supplement his own income and that of his family. So basically, Malkiel earning these high rates of return depended upon lots of positive publicity and people continuing to join his fund. And then he could pay out rates of return to existing investors, pay high salary to himself, and keep the scheme going. Well, he was eventually found out and sentenced to a long prison term. The econometrics text that I use in graduate econometrics, it's Mano Verbeek, I'm sorry. So Verbeek's text had a section on CAPM, and what they said was that beta for Bernie Madoff was 0.04. So in other words, the variability of his rates of return were very close to the stock market as a whole, but he consistently earned his clients 0.5% more than market rates of return. So year in and year out, Madoff was paying his clients 0.5% more than broad index funds while exposing them to the same level of risk. And statisticians who were estimating this and saw it, they said that because of the no arbitrage condition that we looked at before, statisticians argued that it was so unlikely that Bernie Madoff could beat the stock market year after year after year by this magnitude that his rates of return had to be as a result of fraud. And of course they were, but Verbeek was telling in his text that the Securities and Exchange Commission ignored for several years these pleas to investigate Madoff that something fishy was going on. So anyway, CAPM, you can't flout CAPM. That's the moral of the story. Well, on to the quizzes. So first we have problem 1, and we look at Miss Lynch, who can make up her portfolio using a risk-free asset that offers a surefire rate of return of 10% and a risky asset with an expected rate of return of 40% and standard deviation of 10%. If she has a portfolio with an expected rate of return of 17.5%, then what is the standard deviation of her portfolio? You'll notice that what this problem gives us is every term of CAPM but one. So in the following slide, I remind you of CAPM. We expand it out, and you'll notice that Professor Bergstrom has given us each parameter in CAPM except sigma sub I, which is the standard deviation of Miss Lynch's portfolio. So we just have to rearrange and solve for it. So the standard deviation of her portfolio is 2.5%. Very straightforward. Okay. Problem 2, Fenner-Smith must divide his portfolio between two assets, one which gives him an expected rate of return of 15% with 0 standard deviation, so that's the risk-free asset, and one that gives him an expected rate of 20% with a standard deviation of 5. What is the slope of the budget line? So, I've repeated the picture that we had from earlier in this chapter. Remember the slope of the budget line. The budget line is how we can trade risk for return. So I plot the two securities, the risk-free one and the risky one. And to get the slope of this budget line, we just simply take rise over run. The run is 0.05. The rise is 0.2 minus 0.15. So the slope of Fenner-Smith's budget line is 1. Thanks.